Hello and welcome to today's Tax in 10 topic, which is on self-assessment. I'm Ian Miles, a partner at James Cooper Creston, and it is perhaps timely to look at self-assessment in early January because the filing deadline for personal, partnership and trust self-assessment tax returns is the 31st of January, as most people will be aware. There is a clue in the phrase self-assessment insofar as it is the individual taxpayer's responsibility. They have filed a tax return when required to do so and have paid the correct amount of tax by the due dates. You self-assess and HMRC can check later. If you had a requirement to pay income or capital gains tax for the first time, then you should have notified HMRC by the 5th of October after the end of the tax year to which it relates, in order to be allocated a unique taxpayer's reference, or UTR as they're known. This is a 10-digit number, often broken down into two 5-digit elements, which is unique for each taxpayer. HMRC will then issue a tax return, and everyone has a minimum of 3 months in which to file the return from the date of issue. So if HMRC are notified in time but do not issue a return, say until the 1st of December, then you've got until the end of February following to file the tax return. For those already in self-assessment, HMRC normally issue a notice to file a tax return for the year ended 5th of April on the 6th of April or very soon thereafter. Even if the return is a nil return because there's no income or capital gains to report, but if a return is issued, it must be filed by the following 31st of January in order to avoid the automatic late filing penalty. If the return is 3 months late, then it's a £10 a day fine for up to a maximum of £900, i.e. 90 days for every day it's late. 6 months late is the £300 fine or 5% of the tax owing, whichever is the greater, and 12 months late is another £300 fine or a further 5% of the tax owing, whichever is the greater. If the tax due is paid late, then interest is applied at the rate in force at the time, which is currently 3.25%. Additionally, if the tax remains unpaid by the end of February, then there's a penalty that is 5% of the tax due. An additional 5% is added to the tax that remains unpaid on the 1st of August and the following 1st of February, and so on until the tax is paid. If you want to file your return by paper, then there is an earlier filing deadline of the 31st of October, except in the case of excluded tax returns where the 31st of January is the deadline. Excluded tax returns are ones which, for some technical reason, usually because HMRC's software won't cope with the calculations, can't be filed electronically and have to be filed on paper. But in those cases you get the 31st of January deadline, not the earlier one. If you have unpaid tax for the year, then you can apply to have the tax collected via PAYE and your notice of coding, provided that you filed your tax return by the paper filing date if you're filing by paper, or by the 30th of December if you're filing online. This is subject to there being a maximum of £3,000 of tax to be collected. If it's greater than that, then it must be paid to HMRC by bank transfer or cash, and cannot be collected via the notice of coding. You may also need to make payments on account to HMRC. Payments on account are effectively advance payments towards your tax bill, and that includes Class 4 national insurance if you're self-employed. And you may have to make 2 payments on account every year unless your last self-assessment tax bill was less than £1,000 and you've already paid more than 80% of the tax you owe, for example, through your tax code. Each of the 2 payments on account is half of your previous year's income tax bill, and payments are due by midnight on the 31st of January and the 31st of July. If you still have tax to pay after you've made your payments on account, then you must make a balancing payment by midnight on the 31st of January each year. This means that on the 31st of January, you may have to make a balancing payment for income tax and for Class 4 national insurance contributions for the previous 5th of April year end, and the first payment on account for the current year. Now, this mainly applies to those who are self-employed, but can also apply to those who are employed but have perhaps other sources of untaxed income, such as from renting out property when no tax has been collected on the net rentals. You can, of course, reduce payments on account if you think that your tax liability will be lower than the previous year on which the payments on account are based. If you reduce your payments on account by too much, then interest will be due to HMRC for late payment, so reducing them is really a bit of a double-edged sword. There is one way to reduce your tax bill after the year end if you're a higher or additional rate taxpayer, and that is to make a cash donation to a charity where gift aid can be claimed. The conditions for that are that your tax return must be filed by the 31st of January following the end of the tax year, so you can't do it if you file your return late. And the payment made under gift aid must be made after the end of the tax year and before the tax return is filed with HMRC. In that way, it can be related back to the previous year and can be used to gain tax relief in the earlier year rather than the tax year in which it's actually paid to the charity. I think those are the main points that I wanted to make, so thank you for listening and please send us any feedback you wish to.